Are you thinking about buying a home in 2025? You're not alone, and you're not the only one confused by all the loan options out there. FHA loans, conventional loans, down payments, credit scores, mortgage insurance. What does it all mean? And most importantly, which one is better for you? In this video, we'll break down the key differences between FHA loans and conventional loans. We'll cover how they work, the pros and cons of each, and help you decide which loan fits your situation best. So, whether you're a first-time homebuyer or just looking to refinance, you're about to get clarity. Let's dive in. Let's start with the basics. An FHA loan is a mortgage backed by the Federal Housing Administration, a government agency. These loans are designed to help low to moderate income borrowers become homeowners, especially those who may not qualify for conventional loans due to limited credit history or smaller down payments. By contrast, conventional loans are not backed by the government. They're offered by private lenders, like banks, credit unions, and mortgage companies, and typically conform to standards set by Fannie Mae or Freddie Mac. Now, both types of loans can help you buy a house, but they have very different requirements and structures. Let's explore that in more detail. One of the biggest differences between FHA and conventional loans is the credit score requirement. For FHA loans, you can qualify with a credit score as low as 580 if you're putting down at least 3.5%. If your score is between 500 and 579, you may still qualify, but you'll need to put down at least 10%. Conventional loans typically require a higher credit score. Most lenders look for a minimum score of 620. But to get the best interest rates, you'll want at least a 740. So if your credit history is a bit rocky or limited, FHA may be your best bet. But remember, lower credit scores can still mean higher interest rates, even on FHA loans. Down payment is another key area where FHA and conventional loans differ. As we mentioned, FHA loans allow you to put down as little as 3.5%. That means for a $300,000 house, you'd only need $10,500 up front. Conventional loans, on the other hand, usually require a minimum of 5%, although some lenders offer 3% down for qualified first-time buyers. But here's the catch. If you put down less than 20% on a conventional loan, you'll have to pay private mortgage insurance, PMI, just like with FHA loans. So what's the difference? Let's talk about that next. Here's where things get tricky. Mortgage insurance. If you get an FHA loan, you're required to pay two types of mortgage insurance. 1. Upfront mortgage insurance premium, UFMIP, usually 1.75% of your loan amount, paid at closing or rolled into your mortgage. 2. Annual mortgage insurance premium, MIP, paid monthly, typically 0.45% to 1.05% of the loan amount, depending on your loan size, term, and loan-to-value ratio. And here's the kicker. You usually can't remove FHA mortgage insurance unless you refinance into a conventional loan or pay off the mortgage. With conventional loans, mortgage insurance works differently. It's called private mortgage insurance, PMI, and is only required if you put down less than 20%. But unlike FHA loans, PMI can be removed once you reach 20% equity in your home, either through payments or rising property value. That means over time, conventional loans can actually become cheaper than FHA loans if you remove PMI. So if you're planning to stay in your home long term, this is a big consideration. Loan limits are another key difference. FHA loans have set limits that vary by county. In 2025, the national baseline limit is around $498,257, but can go higher in more expensive areas. Conventional loans have their own limits too, set by Fannie Mae and Freddie Mac. For 2025, the baseline conforming loan limit is approximately $766,550. So, if you're buying a more expensive home, you might be forced to go conventional unless you qualify for a jumbo FHA loan in high-cost areas. Conventional loans also tend to be more flexible in terms of property types, like second homes or investment properties. FHA loans are only for primary residences. FHA loans have stricter rules for home condition. The home has to meet HUD's minimum property standards, which means it must be safe, sound, and secure. Peeling paint, broken windows, or outdated wiring can cause your FHA loan to get denied unless the seller makes repairs. Conventional loans have fewer property restrictions. Appraisals still matter, but the standards aren't as strict. So if you're buying a fixer-upper or an older home, conventional might give you more breathing room. FHA loans usually have lower interest rates than conventional loans because they're backed by the government. Lenders take on less risk, but that doesn't mean they're cheaper overall. Remember the mortgage insurance premiums? Conventional loans might start with slightly higher interest rates, especially if your credit score is below 740. But you might save in the long run if you can remove PMI and get lender credits. As for closing costs, they're fairly similar for both loan types. However, FHA loans allow sellers to contribute up to 6% of the home's value toward your closing costs. Conventional loans cap that at 3 to 6%, depending on how much you put down. This can make a difference if you're tight on cash when buying. Let's break it all down. FHA loan pros. Lower credit score requirement, as low as 580. Low down payment, 3.5%. Easier qualification for first-time buyers. Competitive interest rates. FHA loan cons. Mandatory mortgage insurance for the life of the loan. Stricter property condition standards. Lower loan limits in many areas. Primary residences only. Conventional loan. Pros. No mortgage insurance if you put down 20% plus. PMI can be removed with 20% equity. Higher loan limits. Flexibility for second homes and investments. Conventional loan. Cons. Higher credit score requirements. May need larger down payment. Interest rate can be higher if your credit isn't strong. So, which loan is right for you? Choose FHA if you have a credit score under 620. You need a lower down payment. You're buying your first home. You're okay with long-term mortgage insurance. Choose conventional if you have strong credit, ideally 700 plus. You can put down at least 5% or more. You plan to stay in the home long-term. You want to avoid or eliminate PMI. You're buying a second home or investment. There's no one-size-fits-all answer. It depends on your credit, budget, goals, and how long you plan to keep the property. Always compare multiple offers, and don't be afraid to ask lenders to show you side-by-side loan estimates. And remember, the better your credit and financial situation, the more leverage you have. Buying a home is one of the biggest financial moves you'll ever make. Understanding the difference between FHA and conventional loans is the first step to making a smart choice. If this video helped you, give it a like and share it with someone who's thinking about buying a home in 2025. And if you want more deep dives into mortgages, insurance, and smarter financial decisions, hit that subscribe button. Got questions about your situation? Drop them in the comments. Thanks for watching, and see you in the next video.